So welcome back to another webinar series, and this time is special because we have a reunion here at Princeton, and we're very happy to have Liz Myers with us. Hi, Liz.
Good morning.
It's great to have you. And Liz is an alumni of Princeton. She graduated in 1992 at the economics department, I think. And she's with JP Morgan's for 27 years and has done IPOs across the globe. She will tell us lots about corporate finance, IPOs, SPACs, how the rotation trade is going on and other aspects. So we will learn a lot today about the finance in the front lines of 2021 and how the world will change in the coming years. So I would like to start briefly with the poll questions you answered. And I give you the roughly the answers what you gave us. The first question was, will the rotation trade hurt passive investing or not? As people get out of some growth stocks, more to value stocks, and rotate in a different world, potentially because the bull market might end. So the question is 1/3 yes and 2/3 no, roughly. The second question was, do you think that the retail speculation or meme investing will continue after the COVID pandemic, or was it something special which just happened during COVID? And actually, I think 90% think it will continue, and only 10% thought it will not. The third question was about SPACs. We will talk a lot about SPACs today. Is it a useful invention or not? What's your perception now? And 60% think yes, it's a useful invention, 40% not. And what does the S in ESG stand for? And 1/3 thought about it stands for sustainable, and 2/3 it thought it stands for social. And so we will see what we will learn too, and whether you agree with these answers after Liz has told you all the details, what you need to know about all these aspects. So we will go today about many aspects, and we will start with the end of the bull market, but perhaps Lindsay, you can tell us a little bit what you're doing at JP Morgan and what have you done so far, what you have learned about corporate finance in your experience. And I think it will be very useful for a lot of our alumni and students to learn what a successful career you had at JP Morgan Chase, at JP Morgan, and give us some perspective how you think about this and what guidance you can give the young students who potentially would like to follow the same footsteps you did.
Oh, well, thank you, Markus, and it's so nice to be invited, and it's great being part of the Bendheim Center as part of the advisory council. And I've had a fantastic time keeping in touch with Princeton in so many ways, and so it's great to be part of reunions, and I know we're all looking forward to the time when it'll be back in person again. And as Markus said, I've really spent almost the entirety of my career at JP Morgan, save a summer internship in business school elsewhere. But I'm one of the global chairs of investment banking at JP Morgan. And so my job is to advise companies on how to achieve their strategic and financing goals within the ecosystem of the public investing community. So I don't trade stocks for a living. I don't invest money. Most of my career has been spent helping companies raise equity capital, both public and private. And that's really helped me to understand how investors think, and I'm able to help guide companies in different economic and market cycles to think about how their actions might be interpreted and the impact on their access to capital and their valuation of the things that they might choose to do or think about doing. So that's a little bit of a backdrop. And I was an economics major. It was before the Bendheim Center was even invented, if that might date me, but we did have some finance courses back then, which I was glad to have taken. And it's fantastic to see the Bendheim Center be able to provide what it does to both undergrads and graduate students. And Markus, your leadership has been tremendous. So thank you.
Oh, thanks, Liz. And it's great that I can rely on you and your advisory council. That whenever some strategic questions come up, it's nice to always have your advice on these matters. So let's get started right away about what we would like to cover. Let's start with the bull market. Is there some end to the bull market? Can you tell us a little bit about some rotation trade? What is it? Will it hurt passive investors, or is it more in favor of active investors who actively can relocate and readjust their portfolio? And where do you see the heads and the tailwinds coming up?
Sure. Well, I think the recent dynamics have been really interesting, even just in the last couple of weeks. So after being up 16% last year, the S&P 500 this year had already returned double-digit percentages until a couple of weeks ago when we started to see a bit of a consolidation where we were witnessing a rotation from growth into value. And that was really spurred by evidence of inflation from this unprecedented fiscal and monetary stimulus in response to the COVID crisis. So this spooked the growth investor a bit, and they began a rotation out of high growth, particularly technology and healthcare companies, into cyclicals like semiconductors and autos, and defensive names like consumer staples, healthcare, telecom. And at the same time, we saw some investors piling into the reopening plays like travel and lodging that are still trading at a pretty significant discount to the pre-COVID levels. So we had a little bit of a rebound back to what we had been seeing a lot of in the last 6 months or so, which was the tech names getting support. So lots of debate around the halls of JP Morgan and many other financial institutions about what does this mean? Was this a little bit of a head fake, or what are we headed for? And the truth is we don't know. What we do know is that there are some headwinds and there are also some tailwinds out there. Certainly economic recovery is clearly present, and that's a huge tailwind. Which we can all assume will continue for some period. Headwinds, there are a number. Firstly, rising rates, increasing companies' corporate cost of debt, which of course has an effect on earnings. And of course, the big I of the moment, inflation. Input cost increases are pressuring margins of companies, and they're isolated to certain types of products and sectors right now. But I think that's the big question, is how broad and widespread might inflation creep and when? The second big headwind category, I'd say, was the possibility of increased taxes, capital gains tax increases, or the overall corporate tax, or both. And so when will that happen? How much? Hard to say for sure. Our strategists think that Biden won't get to 28% on corporate tax, maybe more like 25%. And maybe it's not really this year, but more likely next year, and likely not retroactive. But again, we only predict, we don't know for sure. The third theme is supply chain disruptions that I think probably have affected all of us in some way or another, and not having access to something that we're used to having in a timely way. It's certainly affected the auto sector, industrials, the semi sector. So those are another element of things that can pressure corporate margins.
Okay, cool. So you see some supply chain disruptions even for your companies you're advising. So let's go to another theme, which is this meme investing. So a lot of retail investors, they are, GameStop and other phenomenons occurred there. Do you see this meme investing lasting, beyond COVID, or was it just, people were bored at home and retail investors just invested too much, and that's why you got these short squeezes and all those things? For institutional investors who go short particular stocks, so bet actually that the stocks will go down. Where do you see this going?
Well, it was certainly very interesting for all of us to watch. Really, since the beginning of last year, retail investors have had an increased impact on both the overall indices and single stock behavior. In the middle of the summer last year, retail was representing over 20% of overall equity trading volumes, which was up really substantially from, let's call it, the low teens in prior periods. We do see some retail investors buying on margin, and that can create more fragile markets when margin calls in a depressed period can drive forced selling. Retail meme investing was certainly the topic du jour for a number of months. And I do think that, and certainly people ask, will the end of the stimulus check and people getting back to work mute some of these tensions? And I think we're already seeing less of this type of retail behavior. And what I would say is, particularly when we saw some of the volatility over recent weeks, retail investors are generally less likely to speculate when broader market volatility rises. So I do think that will have a dampening effect. But we have a new generation of retail investors that have very easy access to trading from their phones. So I don't think it's a dynamic that will go away entirely by any means. And hopefully having some experiences in the market, both good and bad, will help train retail investors how to be thoughtful in their approach over time.
So let me come back to the taxes, because you mentioned corporate tax. And of course, Trump cut the corporate tax, and that led to a huge increase in the stock market. You might expect, if the corporate tax goes back up, it might go the opposite, but we haven't seen this yet. Another tax is the capital gains tax. Perhaps you can allude to that too a little bit. That's probably touching a lot of us who have made some capital gains in the stock market. How will this play out? Will this be more important than a corporate tax, or do you think the corporate tax is more important than the capital gains tax?
Well, I think the capital gains tax is driving some behavior that certainly I see in my seat. Private equity firms, the financial sponsor community are certainly contemplating earlier monetization. So we're seeing a little bit of a pulling forward of activity that we might have seen spread out over the next couple of years in, let's say, a 7-year fund. So we are seeing some of that. And also just the thought of, are we entering at some period where the bull market might slow down? So they have to think about overall asset valuations and the trade-offs for waiting. I think one benefit to the potential capital gains increase for some companies, particularly acquisitive companies, is that many small businesses whose owner or founder might have been considering selling the business have accelerated their decision-making. So we certainly have clients here at JP Morgan that are looking to raise substantial amounts of capital to make sure that they have the opportunity to snap up small businesses if they have an acquisitive business model, or a company that really depends on its growth through inorganic means, like finding great businesses and integrating them with the bigger parent company.
Great. So let's move on to the next topic. And the next topic is about your real expertise on IPOs. I think nobody has probably as much knowledge as you have. And, you know, IPOs have changed quite a lot, but do you think the IPO market will stay as vibrant as it was last year and the early months this year? And what are the latest themes in the IPO market? You know, people talk about direct listings, and then we will go in depth into SPACs. So that's probably the newest invention. We have a whole theme on that. But perhaps you can give us a bigger picture about how the IPO market evolved in the last years, in particular in last year. And so we can zoom in later then into SPACs.
Okay. Well, certainly last year in 2020, there was an IPO boom. The number of traditional, not SPAC, but traditional IPOs was up 66%, and proceeds were up over 80%. And this year in 2021, we're already exceeding that pace on a run rate basis as of May. So when you look at that dynamic, it does feel like exciting times will continue. When you look at the types of IPOs that were dominating, 40% of the IPOs last year came from the technology sector and another 30% from healthcare. So that is a theme we've seen actually for a few years now, and that's an investor preference that seems to be rather persistent. But as we think about some of the rotational flows that we've been seeing, you know, there's always an opportunity that could change. I think the other thought is, you mentioned direct listings. So we spend a lot of time here at work, and I've been doing spending a lot of my time for many, many years on the IPO market. And there's probably been more change in the IPO market in the last 3 years than there has been in the prior 10. Direct listings, you mentioned, we call it sort of one of the categories of the broader IPO 2.0. There are lots of constituents in the financing markets that are looking for opportunities to really keep more money on the table and capture more money rather than seeing aftermarket performance get too high. And so that was one of the reasons that direct listings came onto the scene, which was, how do we perhaps think about changing the dynamic of a book build and a single price point, clearing an IPO and a very active allocation strategy. So the direct listing was where we sort of disintermediated ourselves a little bit to see how it might work if we ran sort of a more of a spread out auction where insiders sell shares at a variety of prices as buyers emerge on the first day of trading. So it's been an interesting experiment. There have been a number of direct listings, certainly the small minority versus traditional IPOs. It's a very interesting process. It is, I would say, not a panacea for things like aftermarket performance and trying to nail down exactly how a deal may perform out of the gates. The clearing price and therefore the valuation of the company is not known in advance, or how the liquidity in the shares might develop, like how liquid a trading market might there be so that investors can get in and out without a lot of friction. It also is a process where research coverage is much more limited, which is something that companies do rely on to help investors learn over time about how their company is progressing. So the role of the research analyst is more limited. But it is an opportunity for companies to have a little bit more direct access to the investor and explaining the thesis of their company. It's not currently permitted legally or regulatorily for primary capital raises. So it's really only for big companies that have insiders that have a desire to sell and provide that liquidity that's needed in the aftermarket for buyers to come in and establish valuation. Primary capital is likely to be approved over time, but right now what we see companies doing is we'll raise some private capital before a direct listing if they need it, or we'll do a convertible after, like we just did for Coinbase this week after running the direct listing a few weeks back.
So on this direct listings becoming more popular too, if you look at last year, as you said, all the IPOs in general went up so much outside of SPAC. Is it the case that direct listings also went up? Where companies said, okay, I just go to stock exchange directly?
Yeah, I would say it's a mixed bag. Many of them have traded very well out of the gates and then settle into a more, sort of relaxed trading pattern, we'll call it. It's very hard to predict in the same way that IPOs are hard to predict as well. We have a lot of information in a book build exercise, and we certainly guide the market through a price range on the cover for a traditional IPO, which is not really the process in a direct listing. So there's lots of... Can you
explain the book build exercise just for some students who might not be familiar with it?
Sure. So in a traditional IPO, we put a range on the cover that makes sense from a peer comparison perspective, and one that we think represents a fair initial entry price for investors. Then we start a marketing process, usually around 7 days, and we collect orders from institutional investors. So they may be a single order, let's say for 10% of the deal at the midpoint of the range, or it might be a scaled order for different price points and different sizes, or it might be a very small, just 1,000 share order. There's all sorts of orders and could be up to, let's say, over 200 orders in an order book for an IPO from different institutions. And then there's also a small retail allocation, which is part of the process as well.
So let me also include a question from the audience. So if the audience has some questions, please type it in the Q&A box. So one question which came up, what's about initial coin offerings, ICOs? Are you involved in this too at JP Morgan? And how do you see that? Is it crowding out IPOs, or is it a totally different animal? Can you elaborate on the distinction between the two a little bit?
Sure. ICOs have not been a big push here at JP Morgan. It's a more limited type of application only for certain types of companies where a token structure makes sense. There's still a fair amount of regulatory uncertainty around ICOs. So until that's clarified, it's probably not likely to be a big push at a place like JP Morgan.
Okay, but you don't see the ICOs crowding out IPOs down the road because it's much more about crypto and other aspects? Or do you think that it might creep into the IPO market as well?
I think you're right that it relates to companies that have some relevance to tokens, cryptocurrency, et cetera. Could it have broader application over time? Yes. I think it's still a noisy, nascent market. And you'll see that we've raised capital for all sorts of constituents in the world of cryptocurrency, Bitcoin miners, cryptocurrency exchanges like Coinbase. I think those are the more high profile situations that I think have broader investor appeal.
So let's move into SPACs, because that was essentially the elephant in the room in the IPO market, in particular last year. So perhaps you could explain a little bit, how do SPACs work in contrast to traditional IPOs? What's different and what makes them so special?
Well, a SPAC, and just to level set for everyone, is a publicly listed vehicle which has 24 months to execute a merger, typically with a private company that's public market ready. And if it's successful, the SPAC founder is entitled to entrepreneurial economics in exchange for some at-risk capital, let's say 2 to 3% of the IPO size. The SPAC is different from an IPO for the investor in that it's sold as a unit, a share of stock, and also a warrant. And additionally, it has downside protection through the right to redeem shares at the time of the merger announcement. So in a low interest rate environment, the opportunity cost of that capital has not been very high, and investors have been willing to buy SPAC IPOs and wait for an acquisition announcement. Most companies don't spend the 2 years looking for an asset. Usually within 5 to 6 months, an asset has been found. So it's an interesting market. It's, I would say, another version of IPO 2.0, as are ICOs, direct listings. There's lots of interesting things going on. SPACs have more advanced regulation than, say, the ICO market, and JP Morgan has participated in many, many SPACs, both on the IPO side and the SPAC merger side. I would say the other thought about why SPACs are interesting today, in addition to the comment I made about the interest rate environment, is that issuers have thought that it's possible that SPACs could be a more expedited route to the public markets with greater certainty and or better direct access to investors to talk about their forecast. I think the expedited aspect is probably really on the margin, and it is appropriate that a company be public company ready before it goes to a SPAC merger. So that's something that I think is starting to be more defined about the SPAC market. And the back end is important too. PIPE investors are a key part of financing of those mergers. And so the public investment in a private equity is the PIPE definition. And that's been a substantial part of the financing raised for the merger ultimately when an acquisition is found.
So do you think, COVID was very particular for SPACs, or did SPACs were around before it? Why did they only pick up during COVID? What was special about COVID that it picked up so much? And how long are these SPACs around already? Is it a new invention, or is it around already for 10 years?
So I think that there was not a lot that was specifically related to COVID. I mentioned that there had been some early success with high growth, unprofitable names like a Virgin Galactic that I think inspired others. I think that was a pretty unique situation in the world of SPACs. I think things that accelerated the SPAC wave more so were big, well-known and high-quality private equity firms getting into the game, venture capital firms who were viewed as really excellent deal sourcers. And as the capacity in the SPAC market expanded with the addition of PIPE capital to float bigger deals, both in the IPO and the merger, it became more needle moving for private equity firms to raise capital in this format, in addition to their traditional limited partner raises for their 7-year-ish fund lives. They became serial issuers and have been successful in doing that. So it's been viewed as a higher probability win for a SPAC investor to be participating in a high quality alternative asset manager backed SPAC. And I do think that the structure of the unit in a low interest rate environment, the option value from the warrants that's packaged with IPO shares was also appealing. And the SPAC dynamics have changed such that an investor can even redeem their capital if they don't want to participate in the merger and still keep the warrant as a way to capture some of that upside.
So you mentioned limited partnership. Can you just, explain a little bit the 7 years? How does it work? That we get a broader background,
Yep. So big private equity firms like TPG and Blackstone and Carlyle and Apollo and Ares and many others. Their traditional business model is to raise long-lived funds, let's call it 7 years on average, of private capital, and they invest that capital over time on behalf of limited partners who invest. Those can be pension funds, high net worth individuals, et cetera. And their job is to invest in companies, help improve their operations, and ultimately monetize those companies through this 7-year life cycle and return the profits to investors while keeping a percentage of those profits and taking a management fee. That's the core business of private equity. The SPAC overlay is just sort of another way to raise what they view as permanent capital. The capital doesn't have to be returned, and so it has some advantage versus a 7-year life fund, for example, where the capital ultimately does need to be returned to the investor.
And why 7 years? Is it from the Bible, or?
There are certainly nowadays 10-year funds where investors are willing to go for longer. And I think we're seeing private equity firms expand the suite of offerings. And of course, many of the larger, more sophisticated ones also have multiple asset classes, credit, real estate, et cetera, and also do sometimes advisory work for institutions that invest with them.
So some people argue that it's a cheaper way to do an IPO because IPOs, there's a lot of commissions for, the investment bank, like traditionally, I think 7%. Is this one driver as well, that it's essentially saving on the fees of doing an IPO?
In the SPAC market, the fees are a little bit lower on the IPO, but there are also fees that need to be paid for the PIPE raises and things like that. So I think all in, it's probably not a popular strategy driven by cost to the issuer or sponsor, more that it's a unique, differentiated way to take a company public.
So recently, the whole movement slowed down a little bit. I mean, it was still going very strong the first month of 2021. It slowed down. Do you see hitting a so-called SPACs wall, that things will not go on like tremendously as it was last in 2020?
Well, last year, 250 SPACs priced. In 2021, the first quarter alone, 300 SPACs priced. So the best way to describe this, I think, is the pig and the python. Can all these companies find targets to acquire? And in the PIPE market, which is so helpful to the back end, as we call it, the merger transaction, is there enough capacity in that market for all the additional capital needed? So there's been a slowing down as the market has digested all of these new issuances and new merger announcements. So it's a process of normalization. I don't think that it's hitting a wall and the SPAC market will go away. There are over 400 SPACs looking for targets, and they have clearly an incentive to find one. They have capital at risk that will be lost if they don't find a target. But at the same time, the investing community is a very good governor on the quality. If an asset does not make sense in the public markets or the valuation doesn't make sense, the PIPE market investors will not fund that deal.
And is it particular industries, particular sectors where SPACs are specializing in? Do you see a trend that it's more tech or it's non-tech or health? Is there, the SPACs specialized and you can only do an acquisition in this particular sector?
SPACs can be generalist or sector focused. I would say there's been a higher proportion of the growth sectors like technology, for example, but there are also industrial SPACs, fintech SPACs, traditional financial services, consumer goods is also a very popular segment of the SPAC market. So there's a pretty broad range, but I would say growth-oriented targets tend to be received the best and winners in their sector. I think it'll be harder going forward for companies that are, let's say, the fifth player in their industry to find a successful SPAC merger as a route to going public.
So very much innovation-driven investment. And do you see a connection with the rotation trade? On the one hand, the rotation trade want to get out of growth stocks, but the SPACs investors still want to invest in growth stocks. Do you see a connection there, or is it too far-fetched?
I think I would say it's the success of any individual SPAC circumstance is really a function of the quality of the asset. And is it true that investors are looking in certain periods, in particular recent weeks, for exposure to sectors outside of traditional technology and healthcare? Yes. Hard to know how long this rotation trade will last. I think there is always room for high quality public companies in any sector. So I think that the rotation trade or not, there are effective entry ramps for companies across all sectors in both the traditional IPO market as well as the SPAC market, direct listings, et cetera.
So overall, you see the whole SPACs development as beneficial for society, is a good thing to have happened. And if you were the head of the SEC or regulating SPACs, would you regulate them in a particular way, or do you see dangers, financial stability dangers, or other dangers there?
Well, it's always head turning to see the amount of volume in any particular avenue creep up so quickly, and this process of normalization that we're in, I certainly think is very healthy. As it relates to regulation of SPACs, I think the SEC is focused on a couple of themes. One is, are companies disclosing what they should so that investors are buying eyes wide open or are supporting or staying in a SPAC at the merger because they understand properly the dynamics of that company. So focused on disclosure, that makes sense to me from an SEC perspective. And I think the goal is to really try to ensure that the disclosure in a SPAC merger is at the level of quality as would be true, quality and depth as would be true in a traditional IPO. The SEC is also wanting to make sure that the promote economics, so the SPAC founder or sponsor receives upside in additional shares in the SPAC merger, to make sure that it's clear to the public how those economics are shared, either between other participants as part of a founder group or how those economics are shared in the ultimate merger, which can sometimes be the case that the target can receive some of the promote shares or even investors in that final back-end transaction.
So there's one question from the audience wanting to know, to what extent is the success of the SPAC market driven by the really low interest rate given the Fed policy? Do you think if the interest rate were to move up, the SPAC market will be hit too? Or, I mean, of course, we know there are IPO waves. Do you think there will be SPAC waves, the same as IPO waves?
Well, I think that the low interest rate environment has certainly made the opportunity cost of money when you invest in a SPAC IPO to be much lower. If you're waiting 5 or 6 months for a target to be found, and then it's several months by the time the merger proxy is approved by the SEC. So for a long time, you can have capital that's not really liquid yet. For the SPAC IPO buyer, they always have the ability to sell in the market. But there's no catalyst for the stock to move until a target is found. So you have a little bit of the dead money problem in the early months of a SPAC. If interest rates are higher, that may mean that there are attractive other investment opportunities. It also may mean that the equity markets aren't trading that well. So that may be driving you away from any type of IPO, SPAC or otherwise at that time, but really a function of what the magnitude of that interest rate change might be.
Very good. So I think let's conclude the area of SPACs and move to a different topic, which is about ESG and green financing. It's another huge development in finance. And how do you see the green investing and green finance and ESG? And perhaps you can reveal what S means in the ESG, which was in our 1/3 and 2/3, there was a divided line, whether it's a sustainable or social or whatever. You will tell us, reveal the secret. And how do you think will it change the corporate fundraising? So if corporations have to raise funds, will they, do it now differently? What are the big challenges for a CEO or CFO in corporations in the world of ESG?
Well, I think so. Firstly, for the great reveal, the S stands for social. And anyone who voted sustainable or sustainability, that's a common mistake, and it makes sense, but it actually stands for social. So the E for environmental sort of captures some of the sustainability aspect right there. The S for social is really for thinking about how companies might be focused on, let's say, the health and welfare of their employees or contributing to their community. And then the G, for those that don't know, stands for governance, which relates to things like what's the independence of the board. Closely held companies have an aspect of governance that sometimes is viewed as less desirable. So ESG together is probably a helpful expansion lens beyond just green, which was in favor many years ago as kind of the only way to be doing good as an investor. And now thinking more broadly, particularly as we emerge from a global pandemic, the S is becoming more interesting and important for investors and for companies. So as we talk about companies and how ESG is affecting them, I have one colleague who spends a lot of time on ESG, and he always says ESG is either an asset or a liability for a company, never neither. So it's really essential that every company thinks about it and is honest with itself about whether it's a selling point or not. And certainly there can be aspects of a company where they have strengths and they have weaknesses. I think that's probably true for most. And the important thing is to think about how to address weaknesses and how to accelerate and get credit for the pros in your ESG profile. So I think, why is this becoming so important? Institutional investors like big mutual funds have seen significant inflows into funds specified for impact investing or sustainable or environmentally focused funds. And we found, even as an interesting study our research analysts covering asset managers did probably 18 months or longer ago, that ESG capital, funds flows into ESG is less correlated to performance than traditional funds flows, which is pretty interesting. So you can actually have worse performance in an ESG fund and attract more capital than if you had the same fund without the ESG approach. We'll see how long that lasts as more and more ESG funds get developed and the competition increases. Performance will undoubtedly be a critical factor in attracting capital, but it was interesting to see that as ESG funds started to become more popular. Investors are not only interested in attracting capital for these types of, these are institutional investors for these types of funds, but they're also seeing pressure by their end investors to weed out what we call brown investments, so investments that are specifically not green. And so investors have begun to use ESG ratings providers, companies like MSCI, who's the index provider, and a company called Sustainalytics, to provide some credence to their selections and judgments about their investments that are going into these impact and sustainability funds. And these ratings are quite interesting. There's some parallels to credit ratings, except that investors are the ones commissioning these ratings to make sure that they're staying true to their fund charters. And the ratings are intra-sector, so relative for peer companies, so relative to peer companies. For example, you can have an oil and gas company rated single A because it has better practices than its peers. And you can have a company in a very environmentally attractive space that could be labeled a B- because it's not doing as well as some of its peers. So it's an interesting dynamic in the whole world of ratings.
So there's a lot of evidence out there that these ratings are very noisy in a sense. There's a recent paper by the IMF arguing that the link between the rating and the environmental pollution, or the growth rate in environmental pollution, is not really there. It's a very weak correlation. So what's the challenge here on the rating agency side for this new form of ESG rating that to make it better? Or is it just a process? We always start with very poor measurements and then improve over the years? Or do you think, there's just not a good rating possible for this type, whether it's green or brown?
Well, I can imagine that all of the consulting firms or rating agencies, however you like to label them, are certainly listening to the feedback. There's also quite a divergence of approach by some of these agencies. For example, the top two ESG ratings agencies view Tesla completely differently. One is focused on the fact that electric vehicles are saving the environment through the replacement of ICE autos, and another agency focuses on the fact that the batteries that go into electric vehicles have very carbon intensive mining processes for the metals that go into them. Cars themselves are made of metal, which is not super environmentally friendly as well. So really, beauty is in the eye of the beholder. It doesn't surprise me that there are now probably at least 7 rating agencies out there, and I'm sure there will be more. What's interesting and different about these agencies versus credit rating agencies is that the companies themselves don't commission them. So they have little influence in terms of thinking about how they're rated. But fortunately, most of the rating criteria is quite transparent.
So can you draw some analogy, to the 1990s where we had, tobacco issues and socially responsible investing in a sense, and people wanted to avoid the sin stocks or stocks companies which were engaged in South Africa because of apartheid. Is this a recurring theme? Is it very different this time around compared to what it was 20 years ago?
Well, I think there are definitely all the constituents that participate in the investing markets are thinking about this in different ways, and the companies themselves. So an energy company today that was pure oil and gas might be thinking about having additional elements to their business that have renewables as their focus. So kind of diversification of business models away from sort of the pure brown type of corporate approach is something that we're seeing, and is probably incrementally helpful, broadly as we think about finding ways to have renewable companies have more a broader base and access to capital and things like that. So certainly diversification of businesses is happening as a function of the ESG lens. I do think that the intra-sector rating approach is appropriate, because what you wouldn't want was all sorts of companies that we rely on every day, for example, energy companies, not having any access to financing. So these agencies are taking, I think, a useful approach in thinking about how one relates to its peer in the sector, and help investors guide companies through their dollars about what they'd like to see with those businesses. So I think it's more nuanced than kind of the blacklist that we saw in the early 90s.
So if you look at the returns, it's not clear how the returns will go by holding, brown or green stocks given ESG investing. in a sense that initially it will make green stocks or green bonds more attractive. So they go up, you get higher returns, but in the long run, the dividend yield or the cash flow yield on brown stocks might be higher because the prices are depressed, and then you get, in percentage terms, you get a higher return on them. Is this a concern at all, that you have this interesting rich dynamics? First, the green bonds and green stocks will benefit and get the capital appreciation, but in the long run, the brown bonds will get the high yield.
Yes, no, it's very interesting, and generally something that has a higher yield also has higher risk associated with it. And so, that's what makes the capital markets go round, right? Is there are all sorts of different approaches, and one investor who may be very much seeking a higher yielding bond may also be doing that to diversify their portfolio, which also contains a lot of lower yielding lower risks types of exposures, or ones that, let's say, are more ESG friendly. So diversification, I think, keeps a lot of the balance around making sure that there are different choices, both for investors in terms of the type of risk reward they're seeking, and also for companies as they think about how to approach the financing markets and how to manage their costs.
So you see a lot of issuers to issue a green bond and a non-regular bond, a non-green regular bond. That's essentially segments the bond market and hence reduces liquidity. Is there a trade-off? So, for example, some governments issuing certain project bonds which are green and other bonds which are not green. Is this at the expense of liquidity, because now we have different segments and less liquid markets, essentially, and that creates some additional costs on the capital market for many firms and sovereigns?
Well, I think it's a really good question, and your observation about liquidity is absolutely spot on. Usually when we think about big corporations issuing green bonds or social bonds, as in the case JP Morgan has issued both, as ourselves as an issuer, the size of those issuances or tranches is usually much smaller. For example, Amazon just issued $18 billion in bonds and $1 billion green bond. So because they're smaller size tranches, yes, the liquidity is smaller just by virtue of size. As a function of size, liquidity can also be lower, not for anything other than these tend to be buy and hold types of securities. So investors that have a mandate that they must have exposure to green bonds for their impact or sustainability fund, they're not looking to trade those bonds. And so as a result, the bonds don't trade very well. And so we think, well, that's not great. How do we get some liquidity going? And the truth is there's always more demand than there is supply right now for green bonds and sustainability and social bonds. And as a result, the cost of funding in that category is lower. So it's interesting to see, though, that if someone actually does want to let go of a green bond that they got a good allocation in, there are buyers immediately available. So it's a sort of a new version of liquidity, and thinking about it. There might not be huge daily trading volume, but if there's a transaction to be done, there will be plenty of buyers and a fair price as a result.
And finally, I have a question about corporate restructuring. Would you go so far if I have a company and I've many aspects and many things I produce, some are brown and some are green, that I split the company apart? I carve out the brown part because it increases my funding costs and make it a separate company and let it go? Do you think there will be even corporate restructuring because of this ESG movement, or that's going too far?
Yes, I think there will be. The tricky part about separating out a brown business is what is the cost of financing that? And typically companies will find the blended cost of having some brown and green assets together is an optimized strategy. Mm-hmm. So you don't want an orphaned brown asset. And so that's why we're seeing some of the more carbon intensive sectors are thinking about ways to diversify their business model rather than trying to separate themselves. But I think there'll be circumstances where we see some of each.
But you can carve out the green part, essentially dilute the existing bondholders to some extent.
Yeah, the green assets are certainly being highlighted in a number of ways, and some companies that have really attractive green assets aren't necessarily getting value for it, and so sometimes green bonds, or we've done green convertibles as well, is a good way to spotlight what you have, and not only can create an attractive financing cost, but also may improve the overall valuation of the parent company.
Very good. So let's. Is it important that central banks' collateral policy is changing in these aspects too? When you say, oh, you advise companies what bonds to issue, and saying, oh, the central bank might take this green bond as a collateral, but the brown bond it won't. Comes this up in any issue, or that's really not first order?
I haven't heard that per se, but it's an interesting thing to watch, how central banks will think about that. My sense is there's always a price for any type of collateral, and it's just a function of how you evaluate it.
So let's move to another aspect which goes a little bit closer. I see that you're in your office, so back in your office, you're not working from home. So let's go to home office work in the future. How will it look like on Wall Street and more general, across the country? Where do you see the big advantages of the Zoom world? So we moved in during COVID. What will remain? And will we go back to the old world? And have you learned certain lessons which will be beneficial in the long run?
Oh, well, I think it's been such an interesting time. And I have to say, I'm very happy to be back in my office. I missed my 4 screens and the door that shuts and just the opportunity that when you open your door to see colleagues, it's where people are continuing to stream back into the office in these recent weeks. And it's been really nice to have a sense of normalcy again. And it's been great to be out seeing clients too. I've had a number of client meetings and both here and at clients' offices. So it's been really good to get back out in the world again. And while I will say it was just unbelievable to see how productive we could be working from home. The volumes of transactions in the equity markets, the debt markets, in the world of mergers and acquisitions were off the charts in 2020, which was just, I would say, unpredictable and amazing to see. And the productivity accelerant of the Zoom culture was really amazing. Faster, easier to act. I mean, of course, because everyone was sitting at home and not traveling, that made it quite easy to convene people. So that's the part that we're all sort of trying to figure out is how will this all work when we're all on planes regularly again? How will we be able to pack in so many things in one day? But what I certainly observed in the work from home era was more inclusive meetings. And I think that was a really interesting observation, is that our junior people got to be involved in some really interesting situations, board meetings, just many investor meetings, and just another box on the screen when there are many is not a big deal. And so I think it was really helpful as we trained our junior staff to give them access to some of really what's going on and to see the fruits of their labor be presented, which they would sometimes have the chance to, but not as regularly as when it was a matter of just dialing into a Zoom. I also noticed when we were doing capital raising that investors brought many, many more people to the table when we would bring an IPO into the launch phase. Usually if you were often prioritizing, of course, the big global mutual funds and hedge funds, and they have personnel all over the world. And many of them were not set up to Zoom someone in. Sometimes someone would join by phone, but it just wasn't the same in a meeting. If someone was, from calling in from the West Coast or from Europe, often they were forgotten that they were even there sometimes and weren't fully able to engage in the conversation. And so I think we were able in IPO roadshows, and I'm sure the same was true in debt roadshows, though those had traditionally been much more virtual, telephonic, Bloomberg roadshows and such things in the world of equity and IPO capital raising, which was very, very much in person for many, many years. To be able to have 8, and sometimes I had one client that was willing to do 12 investor meetings in a single day. Which, I think that's a bar that maybe not everyone should try to exceed, but it was incredible to see the ground that we could cover. And some investors who are, let's say, based in Florida or Texas and weren't necessarily always prioritized for an in-person roadshow had an equal seat at the table in IPO roadshows in 2020 and continue to do so today. So I think capital raising will have Zoom as an integral part of it going forward. I do think that particularly, we've always said when buying an IPO, an investor likes to see the whites of the eyes of the CEO and the CFO and the management team. I think that there is something that is lost when you don't have an in-person interaction. So I think we will see a blend of those. And, it won't be immediate. I think we'll slowly progress over the coming months into more in-person meetings. But I think the efficiency and the productivity of being able to do things virtually probably in many ways was overdue. And in the same way that after 9/11, I remember when clients would have normally said, yes, come see me, and you would get on a plane and fly across the country or fly to Europe or Asia. And after 9/11, the conference call became more popular, and that was a really good thing. And we got a lot more business done and served clients better when they had flexibility in that way. So I think the Zoom culture is just version 2.0 of what happened after 9/11. So I think it's also been great, when I think about the wonderful conferences for CEOs and CFOs and our big board summit. We have 1,000 board members coming to our virtual summit in June. We would never have been able to accommodate that many people in person. And so being able to use a hybrid version going forward where some clients will be in person and others will tap in from Zoom, I think that will be a permanent fixture in the world of sharing our knowledge with our client base. And I'm sure in the same way that we think about Princeton reunions, well, I'm sure Princeton is going to save a lot of money on beer, or the classes will, in the virtual format. I know people are dying to get back to campus in person, but I think there will be absolutely a role for virtual content at reunions going forward. I'm sure I'm not the only one thinking about that, and I certainly don't organize it, but I know that I haven't made it every year to reunions, certainly all of my big 5-year reunions, but I know that I would continue to be interested to participate in some of the fantastic content by virtual format in the coming years.
So if it's hybrid, you will come every year. Is this a word?
Exactly. Why wouldn't you? The content is fabulous.
Yes, great. So let me ask you, one issue is, of course, confidentiality and keeping things secret. So if you have a personal meeting, you can be sure that it's not recorded. But if it's on a Zoom call, is this a big issue, a big concern for these for the meetings? So once you have smaller meetings and you're not really sure whether everything is kept confidential, and perhaps might be secretly recorded?
So I think, typically you can tell if a Zoom is being recorded with that little icon in the upper left. So I think there's less fear of actually using Zoom to record. I think there was always the risk, even for an in-person meeting, that someone had a recording device in their briefcase. So I think that is really no different today. And some clients in our world request smaller meetings, and that's fine. And of course we accommodate that. And sometimes we don't suggest having a broader team join. There are definitely moments for that where a client is particularly interested in knowing the depth of the team down to the analyst level. And there are other times where the topics are extremely sensitive and they only really want one or two of us advising, and that's absolutely appropriate. And that's the nice thing, is it's very visible to see what the setup is. And we've certainly had circumstances where we say these people aren't needed and they drop off. So, lots of dynamic ability to adjust on the fly. But I think that confidentiality, we didn't use Zoom until the COVID crisis hit, exactly because we were working through the security wrapper issues. And, we credit to Zoom, who is also a client of ours, who really helped accelerate to meet the needs that we had for confidentiality in our connections with our clients. So COVID was an unhappy catalyst, but for a happy outcome that we got to a really great product that we feel secure in using.
If you could tell Zoom a wish list, what you would like them to change, do you want 3-dimensional holograms, or what would you like them to work on next?
I remember talking about 3-dimensional hologram type meetings. There's a company, and I will fail to remember the name, that has kind of a doorway set up, and there are 3-dimensional avatars that can join. There's also a company called Magic Leap that does 3-dimensional meetings, and they have fantastic technology to help that progress happen. So I think it's a matter of time and demand for consumers to want to be in that format. When you think about that technology for whether it's healthcare workers who have a specific expertise to be able to be in person, let's say, in person in a 3-dimensional sense, and to see a patient in that way. Think about insurance, being able to go out into the field remotely and see, let's say, a hurricane situation or a car wreck, and to be able to do that type of field survey through three-dimensional means. This is absolutely a technology that's coming our way. And I think is a matter of just continuing to refine and think about applications. Defense is another application. When you think about being able to bring expertise to the front lines with also saving lives, there's a lot of really interesting application of the three-dimensional type of presence.
So coming back to the home office, do you see a big change in terms of mentorship and mentoring, younger colleagues, female colleagues and other aspects? Is this a big advantage or disadvantage? Is it much harder? You mentioned already you can bring junior partners in the meetings much more easily, but in general, the day-to-day advice you can give them, how would you see that? Is it a disadvantage having Zoom, or is it advantageous?
Well, I think it's been easier to, of course, we don't see people in the hallways as much when everyone's working from home. And so that's, again, why I'm happy to be back and see more of our staff back. So you can just have those casual interactions. But with Zoom, I would say it was probably easier for younger people to seek mentorship from senior people. Giving someone 15 minutes on a Zoom, anybody can make time for that. You might not be able to make time to go have a coffee with someone for 45 minutes, but who could say no to a junior person that says, I'd love to spend 15 minutes with you on Zoom? And it's a much more personal interaction than, let's say, someone just calling you on the phone, which people generally wouldn't have done in the past. And I think, we've had lots of virtual gatherings of panels and mentorship and sponsorship oriented type of meetings for people as they progress in their career, young and old, as you think about sharing content and sharing advice and wisdom. Zoom, I think, will continue to be a great way to connect colleagues, particularly, we have a global company, 240,000 people across the world. I used to travel all over the world and visit and try to mentor different groups of people. And now it's much easier and less wear and tear to be able to do that. And people who might be working really hard on a deal that really couldn't have stepped away to go to a networking session can just Zoom in and hear and participate in a way that they wouldn't have been able to before.
So let's move on to the final topic, which is about finance versus tech in a sense. Who is moving the world these days? Do you think, when you decide about an IPO, whether you support an IPO, are you deciding which firm to pick and which technology to pick and why do you pick? Is it more the Steve Jobs, which design about the products, and the tech world, which design our world in the future? Or is it more the financing side with, deciding who will be funded, which company will be funded, and how to decide which IPO to pick? Do you pick any IPO, or to say, oh, this technology is exciting, hence I will support an IPO, and this one is not?
Oh, that's an interesting question. And, as we think about IPO mandates, the most important criteria is the company, public company ready? And is it ready and prepared to accept the I don't want to call it burdens because that's not a positive term, but there's a lot involved with being a public company, and you have to have visibility and transparency on your future results. You have to be set up for the right controls. So that's the first litmus test. Is the company ready? And many companies we think aren't ready yet, and we give that advice. That's true in the SPAC market as well. Some targets aren't ready to be public, and we've given advice that they shouldn't pursue a SPAC merger yet and should raise private capital instead and continue to grow. So I would say, though, once you get past that threshold of can they be a viable public company, I think of it as there is a clearing valuation for almost any company of quality. And it's a function of how do you look versus your publicly traded peers when you think about valuation that makes sense. Investors are always looking for upside. So that means that they don't necessarily always want to buy only the most pristine, successful company in a sector. Many investors are looking for that next up and comer, that next gen company that has the new, cool, disruptive technology, the great healthcare application, or in the case of the biotech, focusing on a really important clinical indication that is worthy of funding. And those situations, are really early stage, and we use lots of very expert people. We have medical doctors on our staff that help evaluate biotech companies. So there's all sorts of judgments that go into thinking about IPOs. But I would say, judging viability is first, and then really it's about judging what's the right positioning for the company versus its peers so that you can attract the capital, and what's the right valuation so that investors feel that they're buying at a fair price and that they have the opportunity to participate in upside. Because ultimately you want the investors who you've allocated shares to continue to buy over many quarters and years and become long-term partners of the company. That's the process of an IPO, is to really find your long-term partners that will be there for you when you see that great opportunity that you want to fund of an acquisition, or even when you have a stumble and you want investors that understand the value of the company and its prospects over time, even if there's been a speed bump.
But when you look at, do you look more at the governance structure of the company, or do you look more at the products themselves? So as I pick a certain, let's suppose you have two competing companies, you can pick one to support an IPO. Do you look at the products they're producing, or is it like the governance?
I think there's a standard level of governance quality threshold that you have to meet. But we've taken companies that are they're controlled companies owned by a majority shareholder. We've done dual class structures to accommodate the certain needs of companies. So governance doesn't tend to be a reason that we wouldn't take a company public unless they just didn't have what was required by the SEC, or if they had a structure that we just didn't think would fly with public investors. But most companies that are seriously pursuing an IPO are already educated by their own external lawyers about what's required. So we don't usually have to be the bearer of bad news if someone doesn't have an attractive governance structure. So what we're focused on is what is the quality of the business, the products or services that they're offering, and what does the financial model look like? Is it predictable? Does it have upside potential? Not every company grows in a linear fashion, and some companies that have a lot less predictability to their results in the coming years, we might recommend that they do an additional private raise rather than go public first. And that gives them the air cover to be able to continue to develop the business so that it becomes more steady and more linear. And that tends to be a more suitable structure for the public markets.
So if somebody is deciding whether, to move more to the finance world or to the tech world, because now finance becomes very tech in many dimensions too, what would you say, what should he think about his career plans? And you decided to move into the finance world, but if you were, a young student now thinking, should I move in that direction or that direction? Do you have any advice to young students?
Well, I definitely have these conversations a lot with students that we are interviewing and are looking at financial firms like a JP Morgan, and also those that are at the same time might be looking at working for a large tech firm or even a startup or a fintech. So I have lots of these conversations, but one element that I always convey is that you will learn more in a finance job, particularly right out of school, in a couple of years than you could learn in 5 years in corporate America. And I think that's because working in finance gives you the understanding of how companies succeed. How do they accelerate to the top of their industries? When you work in the world of finance, you learn that access to capital is essential, and the price of that is essential to manage. Capital is the fuel for all industry. And if it's equity, selling ownership in the company that's your fuel, that means you need to understand what drives your valuation and who are the investors that can make a difference in getting you that next round or those really helpful introductions through your sponsors and early investors. Let's say if you're a fintech, you go work for a fintech, it's really important to understand the importance of capital and liquidity, and having access to both are critically important to avoiding major missteps. If you go work for a company that is going to grow through acquisition, it's really essential to understand how a merger or acquisition is negotiated, and then ultimately how investors might view it after it's done. What are the milestones that you need to convey to get investors excited about? And these are private investors or public investors. How do you get investors excited about the progress of integrating a merger and helping them understand how long that might take and how you're going to manage distraction as you integrate a company? So I could go on and on about what you learn working particularly in an investment bank, but having a foundational understanding of some of these topics is really essential for any management team of a company. And you will find that many companies, whether they be startups or established companies, find talent over time that have had backgrounds in finance. They find that extremely valuable. And while I came out of Princeton, I had no idea how long I would work at JP Morgan. And I didn't have the advantage, as students do today, of understanding what it really is, right? There was no internet. There weren't a lot of brochures at career services that really explained what happened in an investment bank. And so I learned a lot through interviewing, which I don't recommend today. I recommend being prepared before you come in, but I learned a lot. And as I got into the field, I realized how incredibly special it was to have access to the kind of information and instruction that exists. When I worked for a couple months in our JP Morgan training program, as I started my career here, and I thought this is like being at an MBA program. I mean, it was incredible. And today the program is even more tactical and practical to make you successful when you first start out on the desk. But the amount of resources that exist at a firm with 240,000 people, for example, or even at a smaller financial firm, the access to information, you just get very spoiled in these types of environments. And I think it's an incredible platform for any student that's coming out of school, whether it be a graduate program or an undergraduate program, to have the opportunity to really see how corporations function and what drives their success or failure. There's no better education than an environment like this. And I feel incredibly lucky to have the position that I've had, and that's why I never left.
Very good. So let's just conclude a little bit with a silver lining. Also, in the light of a challenge, there was also some questions coming in. Do you see there is also a little bit of a distrust towards intermediation or financial intermediaries, looking at Bitcoin and all the new developments? Do you see this as a distrust against finance more generally? And where do you see the silver lining also in the light of COVID? I mean, you mentioned already many big advantages COVID brought, like the Zoom connection and all that aspects, but perhaps where's your big silver lining in the light of these challenges?
Right. So I think, the threat of disruption is always really good to keeping any company on their toes. And I think where we need to see evolution is helping regulators understand some of the rapid evolution in the world of whether it's finance or technology, and thinking about advancing people who are lawmakers, our regulators, to help them understand the rapid pace of innovation. I think that's one of the biggest challenges, is to make sure that companies are understood in terms of how they function, and to make sure that there's a level playing field. I think that's a really important theme that is true today in the world of disruption, whether it's of the financial world, the technology world, or other traditional industries. And as it relates to the silver lining, I mean, I have to say, I think we all will say work from home was a great period in time where you got to reconnect with your family. And I will say my exercise frequency skyrocketed, which was great. And I'm hoping to keep that going. So it was a good maybe moment to press pause. And after we all got through the shock of what had actually happened and sort of adjusted to that moment, I think we all tried to take advantage of having more family time and less travel. And thinking about, balancing priorities and understanding that as we re-enter, thinking about what were the best aspects that you valued the most at that time, what were the things that were really hard and made you appreciate what you have, and really think about being proactive in designing your life going forward to make sure you're able to keep track of some of those things that were really some of the silver linings of COVID.
Thanks a lot, Liz, for this excellent insights you gave us in connection with the Princeton Reunion 2021 and the webinar series. So we're very grateful for all your insights, and I think it's very useful for everybody, including our students who make these big decisions what to do with their lives down the road. So we stay in touch, and I will draw on your advice for the Bendheim Center in the coming years. I hope that's okay with you. Absolutely. And we stay in touch. Thanks again.
And I know we'll convene in person at some point for our advisory council, and I look forward to seeing the whole group and you.
Thanks again. Bye-bye.
Thank you, Markus.